How's everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. This is the weekly banking update, the flagship show of this channel, where you give me 30 minutes and I try to put you to sleep as fast as I can. No, in all seriousness, get comfy. Yeah, we're going out in just a few seconds. No, just kidding. All right, let's kick off this week. I'm going to go into some. So I've got update on economic indicators coming out this week. I'm going to go into some news with you guys, and I have a couple articles I want to share with everybody real quick as we get down here. So what are some of the economic data points that are coming up this week? So Tuesday, the 25th, we have CB consumer confidence, followed by the FOMC member Bowman is going to speak. And then on Wednesday, June 26th, we have building permits. We've got new home sales, 5-year Treasury note auction, and then we have the Fed bank stress test results. And then on Thursday, the 27th, we have continuing jobless claims. We have durable goods orders, and we have initial jobless claims. We have GDP, goods trade balance, and then pending home sales. And then on Friday, the 28th, we get PCE, which is the Federal Reserve's preferred inflation index. We get the Chicago PMI, the Michigan Consumer Sentiment, and we get the Atlanta Fed GDP now, and we get the U.S. Baker Hughes oil rig count. So we have a ton of economic data and some big things coming out. So we got GDP numbers. We got Mickey Bowman from the FOMC making a speech. We got some building permits, initial jobless claims, 5-year Treasury note auction. We got a lot of stuff happening this week coming up for the end of the month of June this year. Just some other things that I wanted to hit, some other highlights from the week. So we've got the CBO came out with their revised projection, and surprise, surprise, we are going to have a $2 trillion deficit because our government just cannot stop spending money. And I will not stop harping on this because the debt is just gotten so outrageous and the spending is so out of control. It's unbelievable, and it's not sustainable. And we're just, we're killing future generations with the debt burden that we're throwing on top of them. Anyway, repo market continues to go down. The value, the number of transactions, the repo market is going down. I will try to see if I can do an episode on that because I need to kind of get into that a little bit more in depth. And then jobs. I'm going to show you guys an article here on government data points in just a few minutes. But basically, the jobs report, as I've been telling you guys for months, has been just a complete bunch of nonsense. It's been, just blown up, just make believe numbers. And now they're saying that anywhere between 500,000 and 800,000 jobs were basically just made up last year, just made up, never existed. And obviously that brings the outlook on the jobs market into a very different perspective from the headline numbers that we've been fed over the last 12 months. Obviously, big news coming out of Saudi Arabia and Japan. If you did not get a chance to check out my episode that I did last week on Saudi Arabia potentially ending their agreement with the U.S. and ending the petrodollar after a 50-year pact with the United States, definitely go check out that episode. And then this week, I did an episode on the bank. The name is hard to pronounce. Chinkuto. I'm not saying it right. But the bank in Japan basically decided to dump $63 billion in U.S. government bonds as it got major problems with their basically unrealized losses on their bond portfolio, which is a kind of a common theme for what's going on in banking right now. But now this has affected a Japanese bank, which in turn is now going to have a big effect on our treasuries market. So definitely, if you hadn't had a chance yet, go check that episode out as well. So okay, let's get into some news here. So Lazard Inc. is looking to buy a private credit firm to help bolster its $250 billion asset management business, Bloomberg News reported, citing a TV interview with Lazard CEO Peter Orszag. Lazard will be very cautious in the process, both in terms of pricing and culture fit. Orszag told the news outlet Lazard's likely targets are firms involved in infrastructure, real estate, or other private market areas where it does not have much presence yet. Okay, that, and I'm going to kind of tie that in with some of the other things we're going to see here in a minute. So just hold on to that one for a second. The Federal Deposit Insurance Corp Board, FDIC, voted to reject Citigroup Inc.'s living will or detailed plan to wind down a case in case of failure, the Financial Times reported. The banking regulator downgraded its 2022 rating on Citigroup to deficient from shortcoming. The report said Citigroup would face penalties if the plan is also rejected by the Federal Reserve, which is yet to vote on the bank's living will, according to the report. Citigroup said it is confident it could resolve without using taxpayer money or impacting the financial system, the report said, quoting a Citigroup spokesman. Citi has been under regulatory orders to improve risk controls for nearly 4 years. And then the hits just keep on coming for good old Citi. Germany's financial regulator, BaFin, fined Citigroup unit Citigroup Global Markets Europe nearly $14 million for control failures in its algorithmic trading business that led to a flash crash in European stocks in 2022 after a so-called fat finger human error committed by a trader, Bloomberg News reported, citing a statement from BaFin. Citigroup said it was pleased to resolve the matter. I bet they were. Immediately taking steps to strengthen its systems and controls and committing to full regulatory compliance, the report said, quoting an emailed company statement. Here's a big one. Hackers are auctioning off consumer data stolen from LendingTree Inc. unit QuoteWizard.com LLC after the company detected unauthorized access to a cloud database hosted by Snowflake Inc. Bloomberg News reported, citing a person familiar with the matter. There have been several listings of the data on cybercriminal forums, and the data is being sold to the highest bidder, the report said, citing the unnamed source. The LendingTree said the investigation of the matter is ongoing, according to the report. So if you've done any business with LendingTree or somehow this unit, this QuoteWizard, whatever, definitely might be worth looking into. Federal Reserve, FDIC, and the Office of the Comptroller of the Currency are arguing over whether to issue a new draft of bank capital hikes, with some officials wanting to allow additional feedback from Wall Street, Reuters reported, citing people familiar with the matter. The Fed, which is leading the project, is considering reproposing the so-called Basel Endgame rule, which was met with strong industry opposition, but the FDIC and the OCC disagree, the report said, citing the sources. So, yes, this is obviously I've talked about the Basel III Endgame proposal. I've talked about how, some of the requirements in there as far as the capital requirements were absolutely ridiculous and absurd on their face. And that's why this got, thrown right back. But, the FDIC and the OCC, just they, in their infinite wisdom, they just want to trug right ahead with just, having banks hold go from a ton of capital to a ridiculous amount of capital. So anyway, we'll see what happens with that. The OCC approved a final rule implementing a quality control standards for automated valuing models used by mortgage originators and secondary market issuers on residential real estate collateral securing mortgage loans. Under the new rule, the models must ensure a high level of confidence in the estimates, protect against data manipulation, and avoid conflicts of interest, among other things. So interesting. Treasury Department's Financial Crimes Enforcement Network alerted banks against money flows related to the production of illicit fentanyl, which has been linked to more overdose deaths. The Wall Street Journal reported banks are required to screen transactions by their customers and report suspicious activities. Yes, we are. Wells Fargo and Company is losing as much as $10 million every month on a co-branded credit card partnership with fintech startup Built Technologies, Inc., as bank executives reportedly made inaccurate projections on key revenue drivers, the Wall Street Journal reported, citing current and former employees. The entities in 2022 launched a card that lets users pay for rent without incurring fees from their landlords while also earning reward points. Wells has been renegotiating its deal with Bilt for months now and has notified Bilt that it does not plan to renew the contract scheduled to end in 2029 unless things change in its favor, according to the Journal. Additionally, the bank has stopped the bidding on new co-branded card initiatives. There is a great little funny video on this that's out there on the web. You can absolutely find it on. I saw it on Twitter, X. But it is an awesome, funny video where you have these kind of two girls, and the one is Wells Fargo, the one is Bilt Technologies, and Wells Fargo basically the girl chases the Bilt girl around the whole time, basically saying like, "Come on, let me out of the contract. Come on, you can do it. Let me out. Let me out." It's like, no. It's very funny. You should go see if you can find it. Very highly entertaining. Truist Financial Corp has confirmed that its systems were breached in an October 2023 cyber attack after a threat actor advertised the stolen data on a forum, American Banker reported, citing a bank spokesperson. The stolen data belonged to 65,000 employees of the bank, according to the report. So yeah, not good there. Okay, the bankruptcy of banking-as-a-service middleware company Synapse Financial Technologies Inc. has customers worried about losing their money due to unclear records between the fintech and its bank partners. While the four partner banks hold roughly $180 million in cash of users' funds and reserves, Synapse's records show a trial balance of $265 million owed to consumers of a dozen of affected fintech companies. As a result, the trustee of the bankruptcy case, former chairman of the FDIC, Jelena McWilliams, estimated a shortfall of roughly $85 million in deposits. I did a whole episode on the Synapse bankruptcy last week. If you have not had a chance to go check that out, go check it out. I will have another update on that here in a moment, so bear with me on that. Cryptocurrency platform Gemini Trust Company agreed to pay approximately $50 million to more than 230,000 investors who were defrauded by its Gemini earning investment program. Gemini marketed its earning program as a way for investors to grow their money, but actually lied and locked investors out of their accounts. That's fantastic. That's great. Let's see here. Okay. Some banks are moving to sell their branch real estate properties and lease them back in an effort to raise capital and offset underwater security sales. I just did an episode on this in my update on bank bond portfolios, so go check that out. The transactions in which banks sell branches and then lease them back from the buyer have become attractive because they free up cash that banks can use to reposition their securities portfolios and improve earnings without disrupting operations at the branches sold. Sources said in an interview with S&P Global Market Intelligence. U.S. regional banks are striking so-called synthetic risk transfer deals with hedge funds in an effort to increase or preserve regulatory capital through risk transfers, as they prepare to meet proposed capital standards announced last year after bank failures, the Wall Street Journal reported. While Huntington Bancshares signed a similar deal with Bayview Asset Management in December of 2023, Ally Bank and Truist Financial Corp are working on deals to offload the risk on billions of dollars of loans, according to the report citing unnamed sources, data provider FinSight, and letters to the banks from the Federal Reserve. So, okay, this is exactly what I was talking about in the very first thing that I mentioned about Lazard. So here's the deal. If I can sidebar for a second. So here's the deal. And if you followed my Lords of Easy Money series, you'll understand this. So you have the CLO market, collateralized loan obligation market, okay, which hummed as the Federal Reserve was pumping up basically the ZIRP policy, zero interest rate policy, and QE. And that went on for years and all these doing. So now what's happening is all of these companies like Lazard, these private equity funds, these hedge funds, they want to keep that business rolling. And so they're continuing to buy debt. Now, banks right now, they want to unload this debt. They want to unload this debt off to the private equity and the hedge funds, to get the risk off their balance sheet. Okay. However, I think they're unloading a ton of garbage onto the balance sheets of these guys. And again, the private equity, they're hungry for loans because they need to keep feeding that beast. They need to keep feeding that system. And apparently they're willing to take on a bunch of junk in order to keep feeding it. However, I'm going to hypothesize here that I think what's going to happen is these private equity funds and these private equity and these hedge funds, the alternative lenders, they're going to end up with a bunch of crap. And what's going to happen is they're going to go bust. Okay, a couple of these hedge funds are going to blow up. Okay, and then it's going to be right back at the Federal Reserve to bail them out. Okay, it's going to be right back to the Fed. Oh, hey, we messed up. We need you guys to bail us out. But the private equity and the hedge funds are not banks, and they are not regulated the way that banks are regulated. And they have fought that regulation for a long time. And be careful what you wish for, because I have a feeling that could be the moment when, if these guys fail and it becomes a domino effect thing, oh, well, we can't let the hedge funds go down because then they'll take the banks down and then they'll take the economy down. And you have to bail us out. And of course, this is the all bailout all the time economy that the Fed has created over the last 15 years. So of course they'll rush in to bail them out. No questions asked. However, I would like to think that if something like that unfolded, that might be the moment where Congress finally said, you know what? This is our moment to finally go get the hedge fund and the private equity guys and regulate the crap out of them. So, but we'll see. We'll see what happens there. Okay. What else do I got here? Senator Elizabeth Warren wrote Fed Chairman Jeremy Powell a letter, so nice of her, seeking clarity on a May 19th Wall Street Journal report, which indicated that Powell is allegedly giving in to JP Morgan CEO Jamie Dimon's demands by halving the proposed increase in bank capital requirements. Warren further urged Chairman Powell to allow the Fed board to convene for a vote on the original 16% capital increase by June 30th. Well, yes, I'm sure Jeremy Powell will take that into tender consideration. Okay. Most Republican lawmakers are taking a wait-and-see stance on the nomination of President Joe Biden's bet for the new FDIC head. Current FCTC Chair Christy Goldsmith Romero until her confirmation hearing at the Senate Banking Committee, American Banker reported, citing interviews with and statements from Senate's banking Republicans. The confirmation hearing, where the Republican lawmakers can start shooting questions at Goldsmith Romero, is set to be scheduled, the report noted. So yes, so we'll see what happens there with that. Let's keep rolling on here. Got to keep things moving here. Okay, Affirm Products is working out a deal with Apple. So Affirm Holdings, and anybody who doesn't know what Affirm is, so Affirm offers customers the buy now, pay later option. So Affirm payments products are expected to be available to users of Apple Inc.'s Apple Pay in the U.S. later in 2024. This will allow users to pay over time with Affirm when making purchases online or in-app with Apple Pay. Is that a good thing or a bad thing? I'm not sure. When you look at consumers right now and how tapped out they are with the amount of money they've already put into buy now, pay later, with the amount of money they've already put on their credit cards, is that a good thing or a bad thing? I don't know. Retail sales fall short of expectations in May. A wave of $669 billion in debt for apartment buildings looms. We'll have to see if that can get refinanced. The FTC's non-compete ban faces their first legal hurdle with upcoming court rulings. The SBA unveiled a new working capital loan program, although they didn't say exactly how much it was going to be. But the 7A working capital pilot program would use a fee structure similar to the agency's existing working capital program and its SBA Express loan offerings, under which there are no fees for loans under a certain amount, but gradually scale up as the loan gets larger. The fee structure also changes based on whether the loans are shorter or longer than 12 months. So we'll keep an eye on that. A big deadline looms for Realtors Commission lawsuit, and changes are coming. So again, I'll probably have more to come on that. There's a couple of big dates coming up. What do you had? So the one date is August 17th. when the NAR has said it would implement a series of changes as part of its own $418 million settlement agreement over buyers' commissions. The other important date is November 26th. That's the date for a hearing on giving that settlement the final approval it needs. So I will have more to say on that, I'm sure, coming up in August. Benefit of FDIC leader switch. Trump's nominees' lack of bank experience. So again, this is just talking about more of the FDIC and what's going to happen there with their bank leader. FDIC seeks to shorten deal de novo application approval timeline. So the FDIC is aiming to tackle the long pending bank deal and de novo applications with a new process. So the FDIC board on June 20th approved a resolution in which applications that pend for more than 270 days will automatically be put on the next board meeting agenda and stay on the agenda quarterly until a decision is made. During those meetings, staff would be required to brief the board on the timeline and the next steps. I don't know. Am I optimistic that that's really going to make a giant difference in the process? Not really. Regulators issue enforcement action against Evolve Bank for deficiencies. Now, this has to do with the whole Synapse bankruptcy. So the Federal Reserve Board and the Arkansas State Bank Department issued an enforcement action against Evolve Bank Corp. The deficiencies are in the anti-money laundering, or AML, risk management and consumer compliance program of Evolve Bank, which through its open banking division pursued a business strategy that mainly involves offering deposit accounts and payment processing services to fintech companies, according to the Fed's new release and a consent cease and desist order. So yeah, so obviously Evolve's got some issues there. Okay. FinCEN updates on beneficial ownership information. So the Financial Crimes Enforcement Network updated its frequently asked questions on beneficial ownership information. Definitely go check that out, as I reported. And this is pretty funny. The FinCEN director, the beneficial ownership rules are not a gotcha exercise. Sorry if I laugh at that. Speaking at a beneficial ownership information reporting event in Tucson, Gacki, that's his name, Andrea Gacki, said small business owners doing their best to comply with the law should not lose sleep over these new reporting requirements. The CTA penalizes willful violations of the law, and this is where we plan to focus our enforcement action. Yeah, so if you don't report on your BOI, you face a $10,000 fine and potentially 2 years in prison. So you definitely want to look into BOI. I will have more to come with that on the coming months as we get closer toward the end of the year. But I think, again, I am not a fan of BOI. I'm not a fan of this. If we have to comply, if you have to do this, so be it. It is what it is for the moment. I do think that eventually, I think this is a violation of a number of our constitutional rights. And I think this will get, it's already being challenged in court. I think it will ultimately get shot down, but I think it'll take a little bit of time, and we'll see what happens. So Global Group advances central bank digital currency payments experiment. The Bank for International Settlements invited private sector companies to participate in its Project Mbridge experiment, testing the role of central bank digital currencies in cross-border payments. So we need to keep an eye on this. And then also, almost all central banks are researching central bank digital currency. Nearly all central banks are researching whether to issue a central bank digital currency, according to a Bank for International Settlements survey. At the end of 2023, 94% of responding central banks were engaged in CBDC work. Most central banks are working on both retail and wholesale central bank digital currencies. Central banks expect to launch a little later than they expected to central banks expect to launch a little later than they expected to last year. So they I mean, look, they are working on this. Every central bank basically across the world is working on central bank digital currency. They, the BIZ is leading the charge on this, the Bank of International Settlements. And I'm going to do a whole episode on this very shortly. And yeah, this is a big problem. I mean, it's like, but I got to report on this because it's major news. And then whatchamacallit. So the House recently passed legislation restricting the ability of the federal government to introduce a U.S. CBDC, the CBDC Anti-Surveillance State Act, H.R. 5403. Okay. However, it was passed by the House. So what? The Senate's not going to pass it. And even if the Senate passes it, Joe Biden's not going to sign it. So it's dead, and it ain't going, that ain't going nowhere. Small business owners are satisfied with community banks, but regulations threaten lending. So ICBA released findings from a study showing that while small businesses owners prefer community banks, increasingly burdensome and complex regulations threaten to restrict small business lendings. Yes, I would absolutely agree with that. What else I got here? Okay, I want to get in real quick. I've got just a couple articles here I want to run through with you guys in the last couple minutes, and I'm going to run through these rather quickly. So again, this gets back to the jobs report. So this says government data paints divergent views of U.S. job market strength. In other words, the Biden administration is full of crap when it comes to the job reports. So the U.S. labor market remains historically robust or is unraveling rapidly, according to a progressively dissimilar views offered by surveys that form the basis of the government's monthly employment report. The growing data differentials may be clouding a broader economic outlook and revealing a job market that economists expect to be far more brittle than most believe. In May, the U.S. added 272,000 jobs, according to the Bureau of Labor Statistics payroll survey, which polls thousands of businesses each month on their hiring practices and is the most often cited figure for employment changes. Another survey published alongside establishment data, a poll of a smaller number of households, showed a loss of 408,000 jobs. A long view shows a starker contrast with the establishment survey showing 1.9 million jobs added over the past 8 months, while the household poll shows nearly 500,000 jobs lost over the same time. While the surveys have always shown a slightly different picture of the U.S. labor market, results have varied far more since the pandemic and have differed by millions as the Federal Reserve started its battle against inflation with higher rates in March of 2022. The growing gap between the two has thrown the actual health of the job market into doubt, as the Fed has been reluctant to cut interest rates, largely due to the ongoing strength of the American workforce. However, if you remember, Jeremy Powell did just bring this into view that he thought that these numbers were overinflated. I guarantee you these numbers are overinflated. And what's even worse, the worst part about it is that when you really dig into the numbers, you find that all of the job growth is with part-time jobs. It's the number of full-time jobs are decreasing, and all of the job growth has been in part-time jobs. And then it gets even worse than that, because of the jobs that have been created, most of them have gone to illegal immigrants that have come into the country. And again, it's shocking when you really dig into these numbers. It is shocking what you find. Okay, moving along here. Growth in certificate of deposits slow at U.S. banks in the first quarter 2022. So higher for longer rates are keeping the deposit competition heated as certificate of deposit balances continue to increase, although the pace of the rise slowed during the first quarter. So as of March 31st, U.S. banks had an aggregate of $2.939 trillion in certificate of deposits, up 2.4%. From the previous quarter. The first quarter marked the slowest quarter-over-quarter increase since the balances started to go up in the first quarter of 2022. And then we have an interesting chart here, total CDs. We see broker deposits and then Federal Home Loan Bank advances. So we see, kind of brokered advances shot up, but then have kind of leveled off. CDs shot up, but then, like I said, are starting to level off here a little bit. There are a number of banks out there I did not get a chance to report on this last week, but there are a number of banks out there that have actually are testing the waters right now with actually bringing some of their rates down. So we'll see how that works out for them. And then U.S. bond yields fall on cooling inflation views and rate cut hopes. So we see here benchmark Treasury. This is the 10-year Treasury bond yield. We can see we're still floating in here at around a little below 4.5%, probably about 4.4 right in there, still hanging in there. And then, but this, what I really wanted to show you guys was this. The Treasury yield curve, we still remain inverted here. And this has been, where did I want to see this? It just mentioned something here about the yield curve being inverted for almost 2 years now. But anyway, so this is, again, this remains a giant issue. And you can see here, we've had a couple of lurches here where it's almost moved back to positive territory, but then has been, so basically, and this is the U.S. Treasury manipulating the market here on these Treasury rates. This is basically the Fed and the U.S. Treasury working in tandem to keep the yield curve inverted, intentionally keeping the yield curve inverted. And because they don't want the higher rates on the longer end of the spectrum right now, because that'll force up residential mortgage rates even higher than they are, and it'll be a big problem. So they're intentionally keeping this inverted right now. And like I said, more on that to come in the future. And then finally, the last thing I have here is U.S. banks' construction loan delinquencies hit the highest level in at least 3 years. So U.S. bank delinquent construction loans hit their highest point in at least 3 years during the first quarter. Total delinquent construction loans at U.S. banks climbed to $4.86 billion as the end of the first quarter, up from $4.27 billion in the linked quarter. Of the total, non-residential construction loans made up $3.89 billion, while residential construction loans made up $977 million. As total delinquent construction loans surged, so too did the delinquency ratios. So again, we've got a lot of delinquency starting to creep up here in construction loan portfolios. So again, something to keep an eye on here, something to definitely keep an eye on. So, okay. With that being said, I am out of time for this episode, so I will always wrap it up by saying, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to leave your comments down below. You can find us on YouTube, Rumble, and all the major podcast platforms. Please make sure to check out some of the other videos that I post up. That always helps the channel. And I will be back. I'll see you guys again, same time, same bat channel next week. Have a enjoy the rest of the week. Enjoy the kickoff to summer here, and I'll see everybody again real soon. Thanks a lot.